Volatility risk is not a free lunch. In fact, investors demand a positive premium for bearing it. This counterintuitive fact stems from the leverage effect. When prices fall, volatility rises. The leverage effect is the empirical regularity that asset returns and volatility are negatively correlated. When stock prices drop, volatility tends to spike. This is often attributed to financial leverage. As equity value falls, the debt-to-equity ratio rises, making the stock riskier. But the effect is broader, appearing across asset classes. It has profound implications for option pricing and risk management. The key is that this negative correlation is not constant, it varies over time and across markets. Understanding its mathematical foundation is essential for any quantitative strategy. The Heston model is a standard stochastic volatility model. It assumes the stock price follows a geometric Brownian motion, but the volatility itself is also random, following a mean reverting process. The key parameter is ρ, the correlation between the two Brownian motions. In practice, ρ is typically negative, capturing the leverage effect. The model is popular because it can produce a volatility smile, matching market option prices. Let's write down the equations. The Heston model has a closed-form characteristic function for the log return. This is a powerful tool because we can derive moments, like skewness, by differentiating the characteristic function. The third derivative at 0 gives the third moment, which relates to skewness. The result shows that skewness is proportional to ρ times sigma_v, divided by kappa, times a term that decays with time. Since ρ is negative, skewness is negative, and it increases in magnitude with sigma_v. The volatility risk premium is the difference between the expected volatility under the real-world probability measure and the risk-neutral measure. In the Heston model, if the market price of volatility risk is lambda_v, the premium is proportional to lambda_v times sigma_v, divided by kappa, times a term that depends on the horizon. Typically, lambda_v is negative, making the premium positive. This means investors are willing to pay a premium to hedge against volatility increases. Why would investors pay a premium to hedge volatility? Because they are risk-averse and dislike left-tail risk. When volatility spikes, it often coincides with market crashes, leading to large losses. By buying options or VIX futures, investors can protect against these adverse scenarios. The premium is the cost of this insurance. It is positive because the demand for protection exceeds the supply of those willing to sell it. This is analogous to why homeowners pay for fire insurance even though the expected loss is lower than the premium. The positive volatility risk premium helps explain the low volatility anomaly. High volatility stocks tend to have lower average returns than low volatility stocks. Because investors are willing to pay a premium for assets that hedge against volatility, they bid up the prices of low volatility stocks, reducing their expected returns. Conversely, high volatility stocks are shunned, so their prices are lower, but their expected returns are also lower due to the risk premium. This contradicts the traditional CAPM, which predicts higher returns for higher beta. If the volatility risk premium is positive, then selling volatility, for example, by shorting VIX futures or writing options, should earn a positive expected return. Indeed, strategies like shorting VIX have historically been profitable on average. However, they are exposed to severe tail risk. When volatility spikes, losses can be enormous. This is the picking up pennies in front of a steamroller phenomenon. The positive average return is compensation for bearing this tail risk, not a free lunch. Many quantitative models, especially those using machine learning, assume returns are normally distributed. This ignores skewness and the volatility risk premium. As a result, they may overestimate the Sharpe ratio of certain strategies, particularly those that sell volatility. By ignoring the negative skewness, the models underestimate the probability of large losses. This can lead to over-leveraging and catastrophic losses during market stress. Incorporating skewness and the VRP is essential for realistic risk assessment. To see the volatility risk premium in action, compare the realized volatility of an index like the S&P 500 with the implied volatility from options, such as the VIX. Historically, implied volatility tends to be higher than subsequently realized volatility. This gap is the volatility risk premium. It reflects the cost of hedging and the market's fear of tail events. The premium varies over time, often widening during crises and narrowing during calm periods. This chart shows the typical relationship between the VIX and realized volatility over time. The VIX is almost always above realized volatility, indicating a positive premium. The gap narrows during calm periods and widens during crises. This pattern is consistent with the positive volatility risk premium derived from the Heston model. To quantify the volatility risk premium, we can look at several key metrics. The average VRP is typically positive, around 3 to 4 volatility points. The correlation between returns and volatility is negative, around -0.7. The skewness of index returns is negative, around -0.5. These numbers illustrate the concepts we've discussed. In summary, the leverage effect creates a negative correlation between returns and volatility, leading to left-skewed returns. This skewness, combined with risk aversion, generates a positive volatility risk premium. This premium explains why low-volatility stocks outperform, why shorting volatility is profitable but dangerous, and why AI quant models must account for skewness. Understanding these mathematical foundations is crucial for any serious investor or quant. We'd love to hear your thoughts on volatility risk. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.